Welcome back to BRWM's US report. Last time we looked at just how hard it is to predict future stock market performance. In part 2, we'll be investigating the state of America's fund management industry. We'll also be finding out how increasingly both private and institutional investors are opting for a cheaper and more rewarding way to invest. Americans have more than $13 trillion invested with fund managers, but increasingly they're starting to question whether they're receiving value for money. For starters, only around 20% of actively managed mutual funds are actually beating the market over a 5-year period.
If someone says, I'm an active manager and I can beat the market, try taking the rate of return achieved by that manager and all other like managers, and you will deduct from it the fees charged, and there are very few who, over a long period of time, do better than the market.
There are more funds to choose from than ever before, but around 40% of them significantly underperform the market over 5 years, and another 20% don't even last that long.
They will put out any product that they think the public will buy, whether the companies have any belief that that product is any good, because the idea is to gather assets. The idea is to bring in as much money as you can and manage it. And if that product fails, you could then take that money and convince the client to go into a different product that you're coming out with.
In fairness to active fund managers, it's harder than ever before to beat the market.
Market efficiency is the idea that market prices adjust very quickly to new information. And theoretically, one would believe that market prices would incorporate all the known information that's available. And so if that is mostly true, which I think it is, then it's very unlikely that any investment manager or investment fund or group will be able to have the knowledge and information to consistently take advantage of market errors.
Yet despite disappointing returns, the charges that fund managers impose have continued to grow in some countries, especially the UK.
We in the markets get the net return after the insanely high costs of financial intermediation. And those can be as much as, say, 2% a year. And it's very high. It's not only management fees, administrative fees, marketing costs, turnover costs. Funds are constantly buying and selling securities, and it turns out to be about 2% less than the market return. So we all earn 8%, say, we all get 6%. We put up 100% of the capital, we take 100% of the risk, and we get about 30% of the market's long-term return. That is just crazy.
When you have a market that's $1 trillion, and they're able to scrape off $20 billion a year or 2% per year from that to feed themselves, they don't want to give that up. So there's an awful lot of marketing and a lot of convincing of the public that they need active managers, that they need to pay 2% per year, when in fact they don't.
But there are signs that American investors are starting to say enough is enough. Every year, an increasing number are ditching active fund management in favor of a passive approach.
Passive investing is basically attempting to capture the return of an entire asset class or an entire marketplace without trying to forecast the future or identify market pricing errors or anything like that. So you're simply trying to capture the returns of the market with as little cost and taxes and expenses as possible.
So if you have 1% of the money in the market, you buy 1% of each of the stocks. You buy 1% of each of the amounts of each of the bonds outstanding. So you have this truly representative market portfolio. If you think about that strategy, and then you think about all the people engaging in other strategies, active strategies, holding disproportionate amounts of this or that, then you ask at the end of any period, be it a year, a month, you name it, what did the passive investors, the index fund folks, earn before costs? and let's say that's 12%, just to take a number. And then you ask, what did the average euro or whatever currency it may be invested by all the active managers earn before costs? It has to be the same number. After costs, it's a different story. A well-designed index fund should have a very low cost of management. It should have very low turnover, very low transactions costs. Actively managed funds, by their very nature, have higher management fees. They employ more skilled people. They also have transactions costs because they're active. So net of costs, the average euro in the passive sector must outperform the average euro in the active sector.
It's not quite true that no one will beat passive investing. People do and will all the time. It's just that it's like coin tossing. Who would toss 20 heads in a row will happen. But predicting who will do 20 heads in a row is really hard and very unlikely.
That's all for now. Next time we'll be visiting 2 American companies, hoping to persuade investors in Britain that passive really is the best way to invest.